this video, I will describe how to use Volland to read dealer gamma positioning. Gamma positioning has been a popular buzzword for dealer hedging, yet Volland is the only platform that accurately displays gamma and its implications for dealer hedging. Unfortunately, a lot of market moves that are attributed to gamma are actually caused by Vanna, so it is helpful to know exactly what gamma is and how dealers hedge it. Gamma is defined as the movement in delta for every 1 point gain in the underlying price. Whenever there is a movement in delta, dealers must adjust their position to be hedged appropriately. Therefore, knowing how much gamma is changing dealer delta is important for forecasting dealer moves. Every option has positive gamma. So if you see negative gamma, that means the dealer is short an option. Also note that gamma has an inverse sign to theta. This means that if you have a theta positive position, your gamma will be negative. In options parlance, you may have heard the term convexity. This is a reference to gamma because an option will accelerate in value exponentially in accordance with its gamma. Gamma is highest at the option strike price, regardless of the option type, and is generally symmetric in its decline from the strike on both sides of it, like a distribution curve, as you see here. Also, as the volatility or time to expiration decrease, gamma will increase at the money strike. Because the gamma is the same regardless of option type, you cannot tell if a dealer is long a put or call based on a positive gamma reading. Further, it can be confusing if you see two positive gamma strikes around a price and one results in buying and the other one results in selling. To accommodate this, we created delta adjusted gamma, or DAG. DAG basically flips the gamma at higher strikes than the underlying to graphically express buying or selling that is needed to hedge a position. Here is a regular gamma chart, and this would be DAG. Now to the gamma dashboard. On the left, you will see gamma levels at each strike. Volland represents the dealer's positioning, so positive gamma below the underlying would slow selling, while negative gamma below the underlying would accelerate selling. Above the underlying, negative gamma will accelerate buying, while positive gamma will slow it. I understand this is confusing, and that's why we created the DAG chart. Using the DAG chart, positive values mean buying, while negative values mean selling. It is a much simpler visualization. The calculation of how much gamma hedging needs to be done based on the move of the underlying is on the summary sheet, right here. On the cumulative charts to the right, on the exposure sheet, it shows the difference of gamma from the previous day's closing price at the strikes. For the regular gamma cumulative chart, it shows raw gamma, while the DAG cumulative chart shows total buying and selling needed from gamma. A decent approximation is that this is the amount of deltas that need to be hedged per point of the underlying on the DAG chart, and is vital to trade planning through gamma. For instance, if you see a large spike up through gamma, such as this one, say here, that means there would be a lot of dealer buying at that level. Therefore, it would be good to start looking long either for reversal or a strong continuation. The inverse is true with negative spikes and selling, such as this one. Now a quick word on JEX and why Volland's measure of gamma is better. JEX is shorthand for gamma exposure. JEX system was based on an assumption that all puts were bought and all calls were sold. This may have been mostly accurate at one point since options were originally an insurance product, but the popularity of options and the ability to both buy and sell them undermines that theory. In fact, after a CBOE paper describing the perpetual overpricing of options, plenty of hedge funds were selling forward realized variance swaps in options in order to capitalize, particularly in puts. Squeeze Metrics developed a different system for determining dealer-owned options around open interest in a later paper called the implied order book. However, many market data analysts still hold to the assumption that all puts are bought and all calls are sold, despite that being proven untrue. This unravels the whole JEX theory and renders it useless. But Volland is different because our categorization of option ownership is based on the very thing option dealers try to capture, which are bid-ask spreads. Using mid-values between quotes, fair value calculations, and quote confirmations through surrounding transactions, Volland is much more sophisticated in developing an accurate view of the dealer book. Furthermore, here at Volland, we understand that gamma is significant on all options positions, not just the deltas that are traded that day. For that reason, we accumulate the whole dealer book that is ever traded and store it in our database, where it stays until they expire. Finally, we understand that open interest is a statistic that can be misleading with how dealers trade their books, as well as customers, since you do not know whether closed contracts and open interest are the dealers or the customers. That is why at Volland, we do not use the open interest metric at all when determining dealer positioning. In response to this, we have heard multiple times that, quote, JEX just works. But the effect that is observed is actually from Vanna, not from gamma. So please listen to the Vanna webinar for more details. Thanks for listening to this video, and may Volland help you succeed in your trading ventures.